Welcome. You're on The Fringe Show. I'm your host, Tatiana Zalan, and I go live every Friday at 2 p.m. Dubai time. Apart from today, because I'm not live, I'm recording it. I'm traveling overseas, and it's really difficult to stay on top of the technology right now. The Fringe allows you to navigate the rapidly changing world and increase the odds of your success. Here we talk about startups, technology, entrepreneurs, and mental models of successful people, so that you too can also increase the odds of your success and take advantage of the opportunities in the digital world. In the last show, we talked about DeFi. I introduced you to this whole interesting space, and we discussed how DeFi, decentralized finance, is different from traditional finance. We also looked at some of the innovations in this space, and particularly at things like stable coins, automatic market makers, and flash loans. And I said that we really just scratching the surface because it's such a big and very dynamic area. Even if you are 24/7 on it, it's hard to keep pace with how quickly it's evolving. And I also said we're just starting. DeFi as an area, as a segment of the cryptocurrency market industry started in somewhere in 2019, 2020. So we're still very, very early. Today, I'm going to talk about how to get started in DeFi. If you're new to crypto, I don't recommend you go straight into trading. It's highly, highly risky. But there are very interesting ways that are available to us who are not maybe all that tech savvy, who are not doing a lot of trading in crypto, ways to earn passive income as investors. And this is what I'm going to talk to you about. We're going to look at three ways. I've picked up 3 ways, easy ways of becoming a user of DeFi and generating passive income. And these are staking, lending, and becoming a liquidity provider. Before we go any further, I want to give a disclaimer. I'm not a financial advisor. I don't have a financial degree. What I'm talking about here is drawing on my own experience and as well as some research that I do as an academic. It's really for information and educational purposes only. Let's start with staking. Staking is one of the first ways of earning passive income. Staking actually involves locking in your digital assets into a smart contract. The origin of the whole world and the concept of staking goes back to the 2 ways of how we're ensuring consensus of distributed ledgers of blockchains, so that we keep them immutable and trustworthy, and also ensure integrity of the data that's been stored on blockchain. One of them is proof of work, and that's how Bitcoin works, and another one is proof of stake. Ethereum at the moment is moving on to the proof of stake. By that we mean just we're staking, we're keeping, we're locking in the assets, the Ethereum in that case, to secure the network. That's what staking means, and that's the origin of the concept. Now, what we mean by staking, it's essentially like opening a savings account. It's a way of encouraging users to lock their assets for a very long time. Many decentralized exchanges using AMM, automatic maker model, are using exactly that type of option. They offer lots of options to stake native tokens. Uniswap, PancakeSwap, all these decentralized exchanges do that. Network revenues, whatever they generate, they share them with the stakers. And each chain will have their own, what we call APY, which is annual percentage yield. And at this moment, this annual percentage yields are quite high. They're in the high teens. And just compare that to what you have in a normal banking savings account right now. How much does it give you? Just maybe 1%, 0.5%, 2%? Not much. Here, with staking, very low risk option, it can give you in the high teens sometimes. The other way is lending. Now that's a second way of how you can generate passive income. Typically, at the moment, all these lending platforms are providing you with variable rates, but some platforms are now starting to offer fixed rates as well. In the traditional system, I'm sure you've lent some money, probably you borrowed some money. In the traditional system, a bank must assess the creditworthiness of borrowers and set interest rates appropriately to account for all of the defaults. In DeFi, it works very differently. You pull together tokens subject to an interest rate, which is determined by the rate of supply to borrowing. And because the loans are secured with assets held in smart contracts, there is really no need for credit checks or any sort of borrower-specific evaluation prior of you taking out a loan. DeFi loans are generally backed by collateral, and the collateral in the form of digital assets. And loans are generally, not always, but generally loans are overly collateralized to compensate for the volatility. As we know, crypto assets are very volatile, and that's one way of ensuring compensation for this over or excessive volatility. Flash loans that I talked about in my last episode don't work that way. They're not collateralized loans, but with definitely the more traditional loans on DeFi are very highly collateralized. Continuing with lending, what do borrowers have to do? They have to lock up their collateral to borrow assets, and these are bound by smart contracts, no humans involved, and these smart contracts will enforce interest repayments from the collateral if borrowers, for some reason, do not pay interest owed. So the beauty of all lending on DeFi that both parties, both sides to the contract, have full custody of their own assets, and they are able to liquidate at any time. Another advantage is high interest rates. They are relatively easy to use, and they also reduce the risk of default through this over-collateralization. There are a number of protocols that are very popular right now in DeFi. One is Aave, and another one is Compound. Compound, for example, offers something like 8% APY, annual percentage yield, which is pretty reasonable if you think about it for lenders. The third way of how you can participate in the DeFi ecosystem is becoming a liquidity provider. It's kind of a fancy term, so let's have a look at what we mean by becoming a liquidity provider. What is a liquidity provider? A liquidity provider is simply a user, like you and me, who funds a liquidity pool with crypto assets. You own these crypto assets and you facilitate trading on the platform, and because you're facilitating this, you're earning passive income. So instead of traditional order book-based trading systems, which we use in the traditional finance, in the legacy system, what we have here is the so-called automatic market makers. We have funds, and they're held for every particular asset in every trading pair to allow trades to be executed. When these tokens are deposited into a crypto liquidity pool, the platform will automatically generate a new token that represents the share of your own in that pool. This is called a liquidity provider token, or LP token, and it can be used for multiple functions. It can be used on this native protocol, but it can be used on other DeFi protocols and platforms as well, with other applications. Maybe if I give an example, it will be a little bit easier to understand. If we take Balancer is one of those liquidity you can become a liquidity provider on Balancer. You can say contribute to a pool which is currently worth $100. You contribute $10 worth of assets to this pool, and you will receive 10% of that pool's LP tokens. You receive 10% of these LP tokens because your share in the pool is 10%. And all these LP tokens become your claim to the pool's share of assets. Holding these LP tokens allows you to do many things. It allows you to have total control over when you withdraw your share, or it's also without any kind of proof or need of interference from any other protocol, any other intermediary, including Balance itself. So it's completely decentralized, it's completely not based on an intermediary. And since these LP tokens are what we call ERC20 tokens, that's a standard of interoperability into the DeFi system, they can be transferred, they can be exchanged, and they can even be staked on other protocols within DeFi. So unlike the traditional banking system, here in DeFi, it's all highly interoperable. What is also interesting about being a liquidity provider in DeFi is that these assets are non-custodial, what we say. That all these platforms like Balancer, they don't hold your tokens, and that ensures fairness and decentralization that we talk so much about in the DeFi space and the crypto space in general. So how do you make money? So obviously you earn a share of all the swap fees or commissions for all the trades that are being executed or other actions being executed on these platforms. At the moment, Uniswap, which is a big automatic market maker, charges something like 0.3% fee on all swaps, and you will receive, if you are staking on Uniswap, you will receive a fee which is proportional to a share of the liquidity pool. And the more swaps take place in that pool, the more LPs like you, the more liquidity providers will earn. APIs at the moment are pretty crazy, I would say. You can find, as a liquidity provider, pools with 20, 30, and sometimes 70% even. I'm not sure how sustainable the 70% figure is, but 20, 30% are quite achievable. Before you get too excited about becoming a liquidity provider, we need to talk a little bit about risks. And APIs are high for a reason, and because they come with additional risk, known as impermanent loss. And this impermanent loss happens when, or rather because, pool tokens can fluctuate significantly in price. Remember, we're dealing with actually very, very volatile assets. So how can you avoid this volatility? How can you mitigate your risk? You can do it in three ways. One way is just simply selecting tools that are highly liquid. Another way is working as a liquidity or becoming a liquidity provider made up for pools made up of stable coins. And the third way is just to pick up some less volatile assets. Generally speaking, assets like BTC or BTC and Ethereum and some other top protocols are less volatile, they're more established, they're more mature, and the adoption rate is much higher. So they are sort of safer than many other of the cryptocurrencies. So what are the three key takeaways here? I'm winding up here. It's a great way to start in DeFi, where we've talked about staking, lending, and becoming a liquidity provider. Mind you, this is not financial advice. Do your own research. All this, everything that you want to do in DeFi is still quite risky, but you can mitigate your risks, as we've just said. It's a very new space. This is the time to move into it. We literally started maybe 2 years ago, 2019, 2020. Okay, thank you for joining. Thank you for being with the Fringe. And I shall see you on the Fringe show next Friday at 2 p.m. Dubai time.